Welcome you all for the session on technical analysis. So, in the previous chapter about the fundamental analysis, you all know that how to calculate the intrinsic value. Based on the intrinsic value, how investors are going for investment decision. The second part of this is going to be the technical analysis. So, using charting techniques, the investment decision is going to be done by the investors in the market. Either they are going for a short term or a long term investment is based on this technical analysis. So, price and market related data can be used for prediction of market price. Future price of a stock is being identified. But you all know that the stock prices are random, it is independent in nature. But based on the movement of stock, there are some patterns using of charting techniques, using of some statistical tools for understanding the behavior of price in the market, the purpose in which the technical analysis is being used. So the technical analysis, it focuses on the stock market rather than the company. So the fundamental analysis is focusing on the company, industry and the economy, how it is going to affect. Where you can take the technical analysis is not focusing on the company. It is only focusing on the market. It is not comparing the internal performance and external performance. Rather, the external performance, the market performance of a stock is only being taken into the consideration. That the major aspect of technical analysis. And the second important aspect, it seeks to predict the price movement by examining the historical data. Mainly the price and volume related data is primarily used for the purpose of understanding the movement of stock. What is a buying pressure and selling pressure is going to happen in the market. If there is a more buying pressure, is going to be the bullish trend is going to happen in the market. Demand for such stock are going to increase. It is automatically going to increase the price of the stock in the market. Thereby analyzing the volume of trade going to happen in the market. Historical volume of trade is going to happen in the market. Similar to that, the changes in the price over the period of time, we can able to found a kind of a pattern where we need to understand what is the level in which I am going to buy the stock, what is the level in which I need to sell the stock in the market. That I can able to identify from the techniques what is available in the technical analysis. For that, the major thing is going to be used. It is not focusing on the internal aspect. So what is not required, the financial position of a company, relative strength in the market, economy factors are not being considered. Only the thing here is used, the price and volume related data, external performance of a company is only used to predict the behavior, to predict the stock price in the market. And the third important aspect, the underlying idea of the market price already reflects the fundamental of any given stock, which therefore can be ignored. So why we are not taken the fundamental analysis into the consideration? Because you know that there is a market related factors, there is a industry related factors, there are factors related to the economic condition, there are financial factors of a organization, or that there are different type of data we are gathered. Those data are being used for understanding, those data is being used for identifying or establishing the price for the security, or what we can say it is intrinsic value of a security is being identified, or the fair valuation of security is being identified. This is one such thing that what we did in the fundamental analysis. Why we ignore this fundamental analysis? Why we need to go for technical analysis? Because the technical analysis can be used for short-term decision making in the market. That is one important aspect. Because when I can take the fundamental analysis, I need to go for deep analysis. Then only I can able to establish the intrinsic value, understanding of undervaluation and overvaluation. There are such things needs to be identified in the fundamental analysis. Because the thing have been taken by the many of the authors in the field of investment analysis and portfolio management. They feels that already those prices, whatever the factors related to the economy, whatever the factors related to the industry, whatever the financial factors of the company is already reflected in the price of a stock. What we can say, the concept of efficient market, already those information is reflected. Then what is the need that I should take the fundamental analysis into the consideration? So in that particular aspect, what is being taken into the consideration, the technical analysis is taken into the consideration. Is a very important point. On this we can say it is underlying idea of this market is already reflected. It is related to the corporate announcements, related to the analysis report what they can have. It is like the kind of the private information maybe related to that is going to be already reflected in the price. Then it is not required again they need to go for fundamental analysis, rather it is required for the technical analysis. And the important aspect here is it is good idea for the investor to leverage both the benefit of technical as well as the fundamental analysis to fill the gaps available in investment decision making. For that reason they can even go for taking fundamental as well as for the technical analysis. Basic terms used in the pricing charts. So normally in technical analysis, we are using a charting technique to understand the behavior of a stock. Why we need to understand the behavior of a stock? Thereby we need to predict the behavior, future behavior of a stock. That is the reason we need to go for technical analysis, where we can use the different charting techniques. With the charting technique, we can have certain terminology is being used. So what are those terminology? The first one terminology in the pricing chart, which we can call it as support level. It is a level below the price which will be likely not fall. That level what we call it as a support level. Let you can assume that there is an average price of a stock is being identified. Let you can take 3 different trading day. With the price, what is the closing price is being identified. With the closing price, we can establish some average price. Assume that an average price of a stock is about 120 rupee. This 120 rupee may increase, or the prices are going to rise in the market, or the prices are going to fall in the market. In case likely, the prices are going to fall with that the particular stock in the market. What may be the next lowest price, and what is the other lowest prices are going to happen. With that the thing we may use the support levels. Support level 1, 2, 3, like we can have some support level where we need to identify what level, what is the maximum level in which that particular stock prices which may fall, not below that particular level. So that the level is being identified. Let you can take an example with that the 120 is a price, average price of a stock. It is being identified the support level of 100, 80 and 60. So support level of 1, it is 100. It means that the prices are fall below 120. Maybe with that the level they can reach 100 rupee. It is below that 100 rupee it may fall. Further fall it may reach with the bottom level of 80 rupees, with the bottom level of 60 rupees. Like we can able to identify the purpose in which the support levels or the indicators have been used. The next one is a resistance level. The resistance level above in which the price is not likely to rise. What is the maximum level in which the prices are going to increase with a specific point? Once the stock are going to reach that particular point, what may be the next level is being identified. Let's say with the same example, the 120 is average price. The support level may be 100, 80 and 60. If it is likely to increase, the prices are further rise in the market with the condition, it may goes up to 140, 160 and 180. So with that thing what we call it as a resistance level. In case the prices are going to slightly, it is going to increase from 120, it is going to reach 140. In 140 points it is going to reach, it is going to rise again, it is going to reach 160. 160 it is going to rise, definitely it is going to reach the 180. So that the level is being identified, but we call it as support level and resistance level. In that the pivot point analysis, primarily we can use this resistance level as well as for the support level is being identified for the stock. With the based on, it's purely based on the price mechanism, previous price, or we can say the historical price of the stock is being used for this particular purpose. And the next one is a breakout when the stock rises above its resistance level or fails below its support level, what we call it as breakouts. What we can say the breakouts like S1, S2, S3 or R1, 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 R2 and R3. With that it is being identified each points what we can call it as a breakout. So it is going to break out like 120 to 140, 160, 180 are a breakout points. Maybe it fall below that level 180 and 60 are a breakout points is being identified. And the trend line is a regression line that predicts the future price based on the past prices. What is the thing is being followed, the pattern is being followed, with that the particular stock is being identified from the trend line. So the trend line is being identified, what may be the behavior, what may be the kind of pattern is followed by the particular stock in terms of its price over the period of time is taken. Let you can take an example. Over the period, the price of a particular stock is going to be start with 10 rupee, 12 rupee, 14 rupee, 16 rupee, 18 rupee. It is predicted that next trading day it is going to be 20 rupees. So it is going to be the regression line is going to be formed in order to understand what is the kind of pattern, what is the kind of changes are going to happen with respect to the specific stock is being identified. It can be predicted. The stock prices can be predicted using the historical price. And relative strength is going to understand is a relation between, it's a relationship between the changes of a stock in term of percentage is being identified with respect to the changes of the market index. We can say it is the relative strength is being identified. What is the proportion of changes happens in the market? What is the proportion of changes happens in the particular stock? The price of a stock and the index of a market is being identified. Let's say the 10 rupee to 12 rupee it is going to reach, the market is going to reach from 1000 points to 1100 points. So the stock has reached 20%. Market has reached by 10%. So likewise, the percentage is being compared. What is the relative contribution of a stock to the market and what is the influence of market to determine the price of a stock is being identified. So these are the specific indicators which we can use in the pricing chart. There is a difference between the fundamental analysis and technical analysis, because the fundamental analysis we can use threefold approach can be used for identifying, used for establishing the price of a security. The similar way what the technical analysis, the prediction mechanism is being used in order to know using of statistical technique we can able to find out the price likely to be happen for the particular stock in future is being identified in the technical analysis, where we can use the fundamental analysis analyzing the stock value based on the economic financial factor, economic industry related factor and financial factors are taken into the consideration. Macroeconomic factors, industry related factor, industrial strength and the financial position of a company is being taken to arrive the intrinsic value of securities in that the fundamental analysis, where you can take the technical analysis analyzing the historical price movement of a stock is taken to predict the future price of the stock. You can use simple statistical technique to the complex statistical technique in order to understand the movement of price over the period of time and what the price it is likely to be available in the market can be identified by using technical analysis. So here the fundamental analysis, the fundamental factors using various factor, economy, industry and company related factors can be used to establish the intrinsic value of security that can be useful for find out the future price of a stock. Future price of a stock under technical analysis is being identified based on the past price, historical price of a stock is being used for this purpose. And the long-term approach where fundamental analysis you can take, it is a process of investing into the company. It is identifying the company where they are going to invest for a longer period of time. As long as the company exists, as long as the company is going to provide the benefit to the investor, long period they are going for an investment. That you can take for the technical analysis can be useful for short term, useful for trading purpose, in which the technical analysis can be used. Using of charting technique, using of the statistical technique in order to understand the price, what price likely to be that particular stock may be available in future is being identified under the short term prediction. can be used in technical analysis and can take the fundamental analysis using a financial statement for analysis, where here the financial statement is not used, rather the financial statement using a price movement. The charts for analysis can be identified, pattern can be predicted, what type of pattern is being followed in the market, what is the kind of a trend is going on in the market, either maybe a bullish trend or maybe a bearish trend. When there is increasing price movement is happen for the consecutive trading day, are being identified as a bullish trend, where the prices are going to fall over the period of time is being identified as a bearish trend. So how the kind of a trend is going to happen in the market based on the trend movement is being identified for the technical analysis, and can be taken the fundamental analysis. It incorporates the new market information, gather the new market information, the purpose in which the fundamental analysis can be used. Rather, the technical analysis focus mainly on the past performance of the company can be useful for the predicting the price in future, the purpose in which the technical analysis is used. Next important aspect, we call it as the pattern study. What type of pattern is prevailing in the market? With that, it can be identified. With that, we can use the lines technique, what we call it as support and resistance line. Whether the support and resistance line, the support line, it means horizontal floor where the interest in buy a commodity is strong enough to overcome the pressure that to sell in the market. Logically, what the prices declined towards the support and get cheaper, buyer become more inclined to buy, rather than that the seller become less inclined to sell it in the market. So that happened in the market. What happens to the buyer and seller with respect to the commodity is taken into the consideration. So the floor price in which that the particular commodity is available, that what we can say in that the decreased price, the lower price in which the product is available in the market, where it is enough to overcome the pressure to sell in the product in the market. It is going to be the push strategy, the people are going to buy. That happens. Similar to that, the market, what may happen for the support point, whether the support level, the investors who are ready to buy the securities, with that the selling pressure is happen in the market. Who are inclined to sell, it is going to be the less, it is going to happen in the market. That point, what we call it as support point, where the resistance point, the resistance is an horizontal ceiling, where it is going to increase the pressure for pressure to sell higher than the pressure to buy. So the selling pressure is going to increase compared to it is greater than the buying pressure. That particular point of time, the price advances towards the resistance. That going to happen. The seller become more inclined, compared to that the buyer become less inclined to that particular thing. The selling pressure is more, where the buyer who are buying the product is also, it is increased, but not that much level it is going to increase in the market. So normally what we can say, it is the support point is going to be the identifying the different breakout points in the support level, what may be the likely lower price in which the securities are being traded in the market. Similar to that, the resistance point is identifying the price in which it is going to increase in the market, rise in the market, at what point it is going to rise in the market. Whether the reasons are stated here, when you can take it is buyer become more inclined to buy, then the seller become more inclined to sell the product in the market. So we can say here the buyer pressure is going to increase compared to that. Head and shoulders pattern. The head and shoulders pattern can classified into two. It is called it as top reversal and inverted head and shoulders pattern. So the HS pattern, normally how it is going to happen, you know the different types of pattern it is prevailing in the market. Like you can take bullish and bearish market. Bullish at the period when the stock prices are increasing, what we can say as bullish. When we can say the bearish, the prices are fall down in the market, we can say it is bearish trend is prevailing in the market. So you can take the picture number 1 here. This picture 1 is explaining the head and shoulders top reversal pattern. So with this, you can take here, this particular pattern is considered or identified as a left shoulder, and this one is a head. The top peak is going to happen in the market, can be identified as a head, and this is considered as a right shoulder. And what we can say in between of this shoulders, it is going to be the neckline is going to happen. The neckline is going to happen for this two side. So the way in which the pattern is being identified, when the prices are going to increase, the bullish trend, later it is going to be decrease in the market, again the bearish trend is going to provide, and how far it is going to reach the head, the new height is going to reach in the market. What is the new height? Is going to be the new price, the changes in the price, the high price or the peak price in which the stock is going to reach, then it is going to fall in the market, again it is going for the same level of the increase and decrease is going to happen, is being identified, is being considered as a head and shoulders pattern, being identifying the neckline movement and identifying the top being identified here. And what we can say, when you can take the support and resistance level, how it is going to happen, here the support level is going to happen, support level 1 and support level 2 is going to happen. When you can take the resistance level in the top, it is going to happen, resistance level 1, 2 and 3 is going to happen. So the way in which you can able to identify how the support and resistance is going to happen. This is, we otherwise call it as top reversal pattern is going to happen. The kind of, whatever the kind of increase, the level of the price is expected to decrease in the market, we can use in the head and shoulders pattern. Inverted head and shoulders pattern, what we can say, it is opposite to the head and shoulders pattern. The prices are going to it is going to steep decline in the market, again it is going to increase. After that, it is going to steep decline, that the new lower level is going to be identified, new lower level in which the prices are going to touch, again it is going to rise in the market. But what we can say here, it is what the level in which the prices are started, with at the lower level it is going to ended in the market, the over the period of time. This is we identified, and similar to that, the left shoulder and right shoulder and the head is being identified, and this is being considered as a neckline of that particular stock. These are some symptoms which are available, some patterns are available. Based on the pattern, the investor has formulating a strategy that to take the investment decision in the market. Next one is a double tops and bottom pattern. For the first chart is going to explain the double top pattern. Second chart is going to explain the double bottom pattern. That it can identify based on the movement of stock prices in the market, what type of pattern is being followed. So normally what you need to understand from this type of chart, what we can call it as a candle chart, it is the price is going to be identified, what the price in which it was started, what is the closing price, the opening price and closing price, and the high price is being identified. Then you can take here the kind of a candle chart where the prices, what we can call it as a opening price and what we call it as a closing price of the stock, during the period what would be the new height where the prices are going to reach, and the bottom indicates what is a new low that the particular stock is going to reach in the market. And there are white and black color is being used. White color which represents that there is a kind of positive price changes. Positive price changes is being recorded, where you can take the block which is recorded as negative price changes. It means what is positive price changes, that the positive price changes, closing price minus opening price is going to be a positive, is going to be a profit or the price changes are positive. Let you can take an example. 120 rupee is a closing price, 100 rupee is a opening price. During the trading day, investor has generated a profit of 20 rupees. Let you can take, it is being represented as white color. It is being represented in this chart. You can take, it is being represented as a block. It is going to be the negative. It is going to be that the closing price, you can take an example, the closing price may be 100, opening price may be 120, where the 20 rupee is going to be the loss happened during that particular trading day. A similar way it is being identified in the double bottom and double top pattern. It is being identified that you can take the double top pattern. The formulation of this double top pattern started with the prices of a stock, it is declining and increasing, and after that it is going to reach at the point where it is going to be the positive node. With that, the particular positive node, it is going to identify, it is going to create a kind of new records over and above the historical price it was reached in the market. What we can recognize as a double top pattern. Once the top pattern is being identified, next we identify that again the kind of changes are going to happen in the market. Similar to that, the reverse pattern, what we call it as double bottom pattern. New low is going to be identified. New low in which the prices are going to be traded in the market. You can say it is double bottom and double top patterns. And rounded top, rounded bottom pattern. When you can take the rounded top pattern, with that the rounded top pattern is going to be start with the lower point where it is going to reach, tries to reach the higher point, but the way in which it was started, similar to that it is going to reach the lower point in the market. What we can call it as rounded top pattern. You will take the rounded bottom pattern. The rounded bottom pattern here, it starts with the point after it is going to steep decline in the market. After it tries to reach the high point, it means the recover phase, but further fall may happen. Whenever it is going to increase the further fall is going to reach the new low in the market at one particular point of time. After it is going to slight recovery is going to happen in the market. That the kind of correction pattern, what we can call it as double bottom pattern. The next one, the different types of candle chart, the price chart is being used to predict the price movement in the market, which we can classify the charts into the line chart, bar chart and candlestick. The first one, price chart. Technical analysis uses a variety of charts based on the information that they seek. However, there are three different types of charts that are mostly used, that we can classify it as the line chart, bar chart and candlestick chart is being used. The first one is a line chart where it plots the closing price of the share for each trading day over the period of time. And the line formed by joining the dots plotted to a graph shows the movement of a stock price during the specific period of time. You can take from this example, it was started, you can take 6,600 to 6,700. You can take here 6,670 rupees, maybe the closing price at which it is going to reach 6,820. It going to fall below that particular level. What we can have 1,730 rupees. 6,730 rupees it is going to reach. So similar way, whatever the closing points of the previous trading day is going to be connected with the line. Thereby we can use the line chart. The line chart, we can able to identify what type of price movement is going to happen in the market. Started with the 6,670 points, it is going to reach with 6,900 points. What is the type of a trend is being followed in that the particular market? what is the kind of the support points is going to be identified, the resistance is going to be identified, the kind of pattern in terms of bullish and bearish is going to be identified, can be useful to find out the kind of a price which may going to happen. The price is going to be discovered in future can be identified by using the line chart. The line can be drawn, thereby you can able to identify the kind of a changes are going to happen in the market. The second one type of price chart, we call it as a bar chart. In that the bar chart and intraday the valuation, intraday price changes can be identified. The intraday high and low prices of a stock using the bar for each trading day for a specific time period is being identified. So here you can take when this particular chart, a normal thing, you can take this, it is like the opening price, it is like a closing price. Whenever the kind of a high price is going to reach that particular stock during the specific trading day, and the lower price reached by the particular stock during the trading day. That you can assume that the stock has started with the price of, opening price of a stock is 100 rupee and the closing price of a stock is 125 rupees. During the trading day, the price of the stock is increased to 160 rupees and the fall is going to happen in the market for 90 rupees. Going to happen. So what we can say here, the opening price is 100, closing price is 125, high price is 160, low price is 90 rupees. This is, we can take it as from this particular bar chart, where the bar charts are going to be used this particular information, where you can take that the closing price, it is like the previous closing price and the opening price, it is going to be identified, and what the price in which the stock it was opened in the market and the closing is going to happen is being identified. So you can take here, there are two different colors in which the bar chart is represented. The first one, it's like represented in terms of red color. It represents the changes are going to be a negative. It like the closing price, it is ends with the lower price. This ends with the lower price. The second one you can take, it is a positive price changes because it is closed with the high price. Here you can take, it is also going to reach with the high price. The closing price is going to happen. When the closing prices are below or equal to that particular lower level, what we can say, the negative changes are going to happen. It is going to be pictorially represented here in terms of red and green color. Red color reflects that the stock has reached the negative price. It means what we can say, the low price has been reached by the stock in the market, where the stock has booked advances, or what we can call it as the prices are increasing. It is going to end with the green color. So the top of the component, it represents a day high, and the bottom represents a day low price in which the particular stock was traded in the market, and the two additional horizontal line indicates the opening price and the closing price of a security, and the length of a bar which is proportionate to the volatility of a stock in the market. What is the price in which it was reached high? The price it was reached to the bottom level is being represented in that the line. What we can have the vertical line is representing that. Based on that, the volatile movement is being identified. The colored coded is being given for if the prices, the stock prices close above the opening price is considered, it is colored as a green. When you can take the close price is below the open price is colored as a red. Happens in the market. Similar to that, the type of price charts can be used, we call it as a candle chart. The candle chart either can use the red color or green, or maybe the white and black can be used. White or green can be representing to understand the positive price changes, where the red or black is being used to identify the negative price changes in the market. The purpose in which it was used. And here easy to identify how the prices are going to happen. And there is one more thing here, it is called it as a body of that particular candle is being identified. Neck of the candle and the body of the candle is being identified, which indicates the price what it is likely to fall or likely to increase in the market can be identified. With that, the display the relationship between the high and low prices, opening and the closing prices of a stock is being identified by using the candlestick. And the candlestick chart, it represents the body of the candle represents the opening and closing during the specific period of time. The volatile movement and can say the spread of the stock is being identified. The volatile movement can be identified from the high and low. The spread of the stock is being identified from the opening and the closing price of the stock. The above and the below of the body is the vertical line, what we call it as wicks and shadows. Wicks and shadows is representing here. It is a wick, and this is, we call it as a shadow. This line, what we call it as the wicks and shadows, going to happen for that. And while an individual candle which provides the sufficient information, the pattern can be determined the comparing the candle with the preceding and the next candle. The trading day can be useful for find out what type of changes, what type of pattern is going to be formed, is being identified by using the candle chart. The candle stock using the candlestick analysis can be deployed, thereby can identify the movement of the stock using the preceding and the next trading day. The candlestick is being used for this purpose. Can be identifying the pattern like one candle pattern, two candle pattern, and three candle pattern are being used. Where you can take the one candle pattern, it is identified, the pattern is being identified as a hammer, hanging man, shooting star, and inverted hammer pattern is identified. The first one, the hammer pattern. In this hammer pattern, this hammer is being identified. So this Vixen shadows you can take. There is a long shadow is being identified for this hammer pattern. So it is identified the kind of steep fall of the price which might happen for that the pattern. We can say it as the hammer pattern is identified. When there is a small the price changes, small price changes, the positive price changes which might happen, after that the prices are going to increase. So this price changes, what we call it as the hammer type of price changes, where the hammer type of price changes is going to result in small changes, small level price changes, small level profit booking is happens in the market. One thing. The second one, the hanging man pattern, where the historical prices, the previous prices of a stock, it is going to increase, later it is going to decrease in the market, but for the hanging man has the long shadow, as well as what the pattern is being identified here as the loss, small loss is being observed. Later the kind of market is going to be a negative is being identified, where you can take the compared to that the hammer and hanging man that starts with the lower point, steep decline in the market, and the hammer is indicating the hammer is going to breaking that, going to increase small level price changes, going to increase or rise the price level in the market for the first one. The second one is going to happen, the prices are going to increase, the hanging man is going to be again is going to make a kind of steep decline, is going to kind of a loss happens on the consecutive days or consecutive trading days is going to happen. And it is going to be a shooting star, the small price changes are going to happen compared to the previous losses, the changes of profit that might happen. Inverted hammer is going to be the long wick is going to happen in the market. where it is going to reach the highest price and ends with the small changes, small positive changes that happen, which is result in previous or preceding day. It is going to be the long or the spread of loss happens in the market, followed by small price changes, small positive price changes happens in the market. We classified as inverted hammer. The second one, two candle patterns. The two candle patterns is classified, the patterns are classified as bullish engulfing, bearish engulfing, piercing, bearish harami, and bullish harami are the 5 different patterns, where can take this 5 different patterns to understand the market. The first one, bullish engulfing, it is result in positive changes. You can take the preceding days in the first chart. The market that started a kind of bearish, the prices are decline in the market, an abnormal decline is going to be identified. Later, by overcoming this abnormal decline, like the Vixen shadow, overcoming that, there is a tremendous or abnormal price changes, abnormal positive price changes are going to happen in the market. The type of pattern is identified as bullish engulfing. So the bearish trend is started and ends with the bullish. By overcoming that, overcoming previous or historical price, the new history of price, the new prices, new price changes are happens in the market that overcome the kind of negative price changes for the preceding trading day, that we can classify it as bullish engulfing. Second one, the bearish engulfing, started with the positive, started with the bullish trend, it is going to reach the high price. Later, by overcoming that price, the kind of steep decline of price may happens in the market, that we can classify it as bearish engulfing. It is going to happen, it is going to reach the lower level, the price compared to the opening price is going to happen in the market. And piercing is going to identify the kind of bearish trend is going to reach in the market, negative price changes are happens in the market. After the period of time, it is going to identify the positive changes, but even though that positive changes is inclined towards positive, inclined towards bullish trend is going to happen, that we can call it as piercing. Next one, bearish harami. The bearish harami, the prices are going to increase. It looks like a bullish trend, but later it ends with the bearish. But the level of loss is not that much level is going to affect the market, that we call it as the bearish harami. And the bullish harami is going to be the bearish trend which was happens in the market, the kind of loss. After that, the recovery phase, it is going to increase. The price changes, the positive price changes are being identified under the 2 candle chart. The next one is the 3 candle pattern. It is identified as evening star, morning stars, and dojis. The evening star is being identified, the occurrence, there is positive changes and going to reach the market, and high price changes are going to happen in the market. Later, it is going to identify the kind of loss, can be classified as a evening star, and the morning star is going to be that the positive price changes after reaching the positive change with a below that particular point, below the loss, can identify or booking a kind of positive trend, and abnormal profit is being identified. That abnormal profit, what we can classify it as Morningstar. And the dojis are the opening price and the closing price are same for the specific trading day is being classified as a dojis. These are the different types of charting techniques are being used to identify the market, identifying the market prices.